Today I wanted to show you guys intercompany equipment or machinery transactions and the elimination entries for such transactions. So let's begin. Let's say that on January 1, year 3, parent company sold equipment to the subsidiary company for a selling price of $120,000, and the actual cost of this equipment is actually $100,000. Parent company's depreciation policy is straight line method with a useful life of 10. Subsidiary company decides to depreciate this asset using the straight line method with a useful life of 8. Also, please note that the parent company sold an equipment to the subsidiary company for a selling price of $120 and a cost of $100, which it originally bought on January 1, year 1. Okay, sorry about that missing information. All right, let's go ahead and create the internal journal entries. So in parent company's internal books, this would be recorded as a debit to cash for $120. You're going to credit the actual equipment for $100. Also, we're going to calculate the accumulated depreciation. So $100, and their policy is to use straight line method with a useful life of 10. But also note that the equipment was originally bought on January 1, year 1, and it is being sold on January 1, year 3. So that is 2 years, which gives us an accumulated depreciation of 20. So accumulated depreciations are usually credited. We're going to get rid of it, so we're going to debit it for 20. So that leads to a gain in the sale of transaction of $40. Well, on the subsidiaries books, internal records, this was recorded as a debit to equipment for $120 and a credit to cash for $120. So these were my January 1, year 3 transactions, right? Well, on December 31st, S, as in the subsidiary, on December 31st is going to create a depreciation expense journal entry by debiting depreciation and crediting accumulated depreciation, and the value is going to be $120, which is the price that they bought the equipment at, divided by 8, and their policy is to use the straight line method with a useful life of 8. So that gives us a depreciation expense of 15. They will debit 15 and credit 15 for depreciation expense and accumulated depreciation. This is what S would do before consolidation. But what happens when you consolidate? And I'm going to call this the actual entry, as in the correct entry. When you consolidate, you become one company. So this whole sales transaction never took place. They never sold the equipment for $120 to anybody. That equipment is still in their books for $100, because under consolidation concepts, we eliminate all intercompany transactions. And so if we assume that there was no intercompany transaction, then this $120 does not exist, and the equipment is still in our books for $100. In that case, we would debit depreciation and credit accumulated depreciation for 100 over the parent's useful life, which is 10, which gives us a $10 depreciation expense and accumulated depreciation. So we have to correct this. This is the actual journal entry. This is wrong. So we can see that our depreciation expense is overstated by 15. So we're going to have to reduce the depreciation expense by 5 by crediting depreciation for 5 and debiting accumulated depreciation for 5. Now, let's combine all these journal entries. So, we'll combine as well as eliminate any intercompany transactions, okay? So let's start off. The first thing we're going to do, step 1, is eliminate all intercompany transactions. So we had a debit to cash, right, over here, but we also credited cash over here, so they cancel each other out, right? Okay, next we have a debit to accumulated depreciation of 20. We're going to credit accumulated depreciation for 20. We have a credit to equipment for 100. We're going to debit the equipment for 100. We had a gain of 40. We're going to debit the gain for 40. On this side, we had a debit to equipment of 120. So we're going to credit that equipment for 120. So what is our balance here? Our balance here is a debit to gain for 40, a credit to accumulated depreciation for 20, and a credit to equipment for 20, right? Because debit 100, credit 120 is a credit 20. So that is our journal entries. However, remember that we created these correcting entries. So we're going to combine these correcting entries too. So we're going to debit gain for 40. We're going to credit accumulated depreciation for 20, but also here's a debit for 5. That creates a net accumulated depreciation of 15. We have a credit to equipment of 20. And then finally, we have a depreciation expense of 5. And this is going to be your final journal entry.